Hello, everybody. It's my great pleasure to introduce today's guest, Peter Levant. Peter brings with him over 30 years of experience in the financial markets. During his career at Morgan Stanley, he executed more than $200 billion in institutional trades. He holds an MBA, graduating summa cum laude from the École des Hautes des Études Commerciales du Nord, which is and pardon me, Peter, if I mispronounce that, which is a top-ranked business school in France, as well as a master's in finance from the London Business School. He is the author of the Trend Tracker newsletter, which provides a systematic analysis of the S&P 500. And by the way, Peter's Trend Tracker is on golden medal, so please have a look at that today. The Trend Tracker is also part of the Diamond package, which Golden Medal is continuously expanding to include valuable experts such as Peter. So to those of you who are interested in testing our Diamond package, you should use the links that are going to appear in the chat window. Peter, it's good to have you here. Welcome.
Thank you for having me.
Peter, I thought maybe it would be best to go over, because you do specialize in the S&P 500, to go over your methodology, your overall approach, how you conduct your analyses, and we can start from there and then move on to other topics.
Okay, that's a big one, but I'll distill it to the main points. So the S&P 500 index is a cap-weighted index. As we all know, it means the top members have the biggest weighting. Incidentally, it was launched on my birthday on March 4th. We have something in common there. The S&P represents 80% of the entire US stock market, so it's pretty much the main index that there is. It's also got somewhere along 12 to 15 trillion of assets directly linked to it. So from a listed perspective, it's probably the deepest, most listed market there is. Yeah. I don't know if it's possible to share the screen, but that might be.
Yes, Peter, it's very much possible. You have that in the icon tray, that little button there that has the up arrow share screen. Yep.
All right. So this is actually today's cash market, a 5-minute chart, but that's not what I wanted to show you. What I wanted to show you was the change. It links to something we were talking about backstage. The S&P has changed in profile in about the last, let's say, 2010 to 2025, where the top 10 stocks went from 18% weighting of the index all the way to 40. It's quite a tremendous change. So what I've found is that coincided with the incredible algorithmic trading, the homogeneous behavior, and in fact, patterns are more persistent now than they've probably been in a long time. So it wasn't just by accident that I made a shift from technical analysis discretion to mechanical trading. It was also a function of what's happening in the market.
Peter, are there any particular stocks or any sectors of the market that are your favorites? We can maybe go over those.
Yeah, clearly you can't ignore tech because that's been carrying the weight for a while. But today's a very unusual day because of the Fed. We're talking about the quarter-point cut. I may have skipped a step there. My strategy and what we do is short-term trend following. And basically all it means is that you take trends using moving averages, using various indicators, you try to identify them, measure them, and then develop signals for where would be entries, and then you have to back test it. So it's easy to say in those words, but it's a tremendous amount of work if you want to do it correctly. But we're short-term mechanical trend followers.
And any particular, so outside of the tech sphere, Peter, any particular stocks that perhaps are on your radar right now that we could talk about?
I think, again, to go back to what we talked about backstage, I think I would watch consumer discretionary to see if the consumer is still strong in the US. By the way, I'm obviously US centric because that's the market I cover. And I would watch these tech stocks and watch if they can deliver on their promises, because NVIDIA's PE of 48 and things like this, Palantir's very high PE, I would be watching these because the market, if you took these out, as of recently, did not do very much. So I'm not sure which sectors are going to benefit from a rotation or if it would just be wholesale selling and getting out of the market, because it's pretty frothy at the moment. It's priced to perfection, as we say.
Okay, I'm about to put in a question here from Patricia Miller. Let me just highlight it. All right. Okay. Hello, Patricia. Thank you very much for your question. Patricia is asking, why do you focus on the S&P 500 and not so much on commodities or gold, or do you watch them anyway and you simply specialize in the S&P?
Okay, so years ago I managed a commodity futures trading desk, so I traded them a lot in the past. I watch them. For example, on my watch screen, I do have, I'll give you an example of what I have on my screen here. I have the main euro currency. I watch gold, which made new highs. I'm watching oil. I cover crude, not Brent. The thing about commodities, which by the way, they can be very good investments, is that those major cycles and to get to the actual supply and demand, the right price can be a little tricky. And with the S&P, we can measure price earnings ratio. We can measure what is the risk premium good to buy a stock versus going into a treasury bond or bill. So the metrics to see what's the right price are just a little bit easier in the S&P. I'm not going to say it's easy at all because none of this is easy. But is 3,300 the right price for gold, or should it be 5,000? We'll see. But to that point, trend following originated from the major commodity markets. So in fact, the strategy that I do, you could do it in commodity markets that show trending properties, that's for sure.
Peter, when it comes to risk, how is risk management factored into your system?
Oh, it's key to everything. Conventional trading is, you have a bunch of risk metrics. So the first one would be of the amount of money, the amount of capital that you're trading, what is the per trade risk? So you decide to do a trade, is that per trade risk 0.5%, 1%, 1.5%? The upper bounds is typically 2%. So obviously if you had $100 and you lost 2%, you lose 2, you still have 98 to move on. So that's the first metric. The next metric for active traders would be some sort of a daily loss limit, meaning how much can you sustain a day? And typically for active traders, that's a single digit number, 4, 5, 6%, what have you. The minute you were to get to something like 10%, 5 days in a row of max loss, that's a serious drawdown, 50%, right? So risk is everything, but it's more about when you're trading the sequence of events. So obviously if you have a whole bunch of losses in a row, that's much more serious than having a handful of losses over several months that are in between trades that are profitable. But risk management is utterly key to everything, especially in futures with leverage. Yeah, because futures are levered products. That's a very important point.
Peter, I'm going to try to squeeze my question in now before the one that I asked you when we were backstage before we head any further. So I was wondering, because today I was reading an article about Apollo's chief economist stating, Torsten Slok, I think is how you pronounce his name, and he is warning that AI is in a bubble, AI-related companies are in a bubble, and of course the top 10 companies in the S&P 500, and he's not the only one who's providing this warning right now. So I was just wondering, because I know from previous webinars that quite a few of us here have an interest in the various tech companies, how that could potentially impact the S&P 500, and basically your take on what's going on right now.
That's a very good question. Without a doubt, the whole AI sector from hardware to software is priced to perfection. So there's not much room for error. If anything, there's potential for disappointment. However, these valuations imply super growth. And that's what we're seeing. NVIDIA's upping their sales numbers and whatnot. I know recently that issue with China, but AI is such an important, in fact, AI is driving, I'll pull up a chart here. It's driving the S&P quite simply, the same way .com did. Let me try to find, here it is. So this is a paper I'm working on now. I already showed this chart, and bear in mind that this 40%, there's a lot of AI names in there. So look, this is a long-term chart, 20 years. And here's some events we all know. We're talking about AI now in mid-2025, but there are early investors who were talking about this 2 and 3 years ago. In my perspective, the market, see this bottom here? This is when AI is gaining traction, okay? This is the Trump tariffs, whatnot. Here might be some early people thinking about it, but we're talking about 3,500, 66, we get near 7,000. If you had to say what doubled the market, you could say it's AI. So to your point, it's a very big risk. When you've got something that's in and out of 40% of the market, let's just say the stocks get overheated, especially because they're so racy, and they do a 30% pullback, 25% pullback. That would have a massive effect on the S&P. Either people come out of those AI names and support the rest of the market, which I don't think they do. That'd be a sector rotation move, or they actually take the capital out and put it on the sidelines and wait to get back in. So yes, AI is a huge risk. On the other hand, as many people say, the market can stay irrational longer than I can stay solvent. So I wouldn't be shorting these names because who knows when this is going to happen or if it's going to happen, but it's a very big risk. The concentration risk has never been this much in the history of the S&P. Let's put it
that's
that way.
huge. But for those who are all, so for example, you're saying for those who are already invested in those companies, perhaps it wouldn't be wise to head for the exits just because of this. But what about those who are contemplating making an entry, given the situation as it is?
Yeah. Okay. So I'm not much of a momentum trader. So any kind of good pullback might be a point to get in. I must say it's hard to make a case to put money to work in those names in these levels unless you have a very long time horizon. Because you can go in there, something could happen in the fall. Maybe the Fed is less dovish, more hawkish. The pace and speed of cuts isn't the same. There's some regulatory banter between China and US and chips and all these things, and there could be a bump in the road. Most likely, over the next several years, I believe certainly AI is here to stay. I use it all day, every day, and as a productivity boost, it's incredible. But I'll tell you today alone, I found 3 pretty serious errors that if I didn't know my domain very well and I were to reproduce those errors, it can be a little bit of a Frankenstein. You have to be careful with what you're doing with it. So I hope that answer helped. For traders, you could do selling covered calls. You could buy puts if you already have a position on. You could lighten the position. For people looking to enter, I hope we have a pullback. It's tough to say buy it here because we're at an all-time high, but we'll
But
see.
given a 40% weight in terms of what's driving the S&P 500, these tech companies, which do have in some ways are connected with the AI, with the push forward in AI technologies, that does sound like a bubble. That sounds like bubble territory, very much so.
Yes, it does. And how can I put it? The academic definition of a bubble is that there's stages, there's the price rise, there's a frenzy, then they create more instrument to get into it, then people lever, and then at some point it pops. The only thing is that I believe AI as a tech is here to stay. So I just don't know what the value is. And also we got to remember, I keep coming back to NVIDIA. Apologies, it's the name I know the best. But it's not easy to build a chip fabrication facility. It takes many billions and many years. So NVIDIA has a monopoly right now. People need chips, and there's no place else to go. And that's why they were able to get this $4 trillion valuation.
And so as with the dot-com bubble in years past, that there were companies there that were also at the forefront of certain technologies, some which made it, others which didn't. And of course, that's the thing, right? That's the big question, is there isn't really any way, or is there any way of knowing who's better positioned to survive?
I would say if you stick with the big names that have monopoly pricing power that are dominant, when you're pricing any network, the bigger the network, the more valuable, right? So just the things you use every day, the Instagram, Facebook, Snapchat, LinkedIn, all these things, you can't readily jump to another network to do what you're doing because everyone
No.
you know is in that network, right?
Yeah.
So I would say that AI has a place there because, for example, all the companies that are in this 40%, they all have serious AI departments. Obviously, NVIDIA sells the picks and shovels, but the other companies are using AI to make their businesses better. I would say stick with really good quality, maybe second and third. So if technically we have a pullback and we start to break trend lines, I would probably get out of second and third tier names just because those would be the ones that are just riding up the hype. Maybe they don't have the fundamentals to back up their share price and they're just in this bubble or in this craze. But we still don't know if it's a bubble. Who knows? Maybe the right PE for these companies is between 30 and 50, and that's just the way it is. They're not companies that should have 10 PEs, for example.
Next question here from Patricia Miller asking, I saw that you had two very quick trades in the trend tracker, but I also saw that your articles include nice explanations of what's going on in the markets. Thank you. And I got the feeling that it was more swing trading oriented. And I'm wondering if you're going forward, you're going to focus on just those very quick trades or maybe also on some bigger moves.
That's a good question. My own trading is intraday and can be 10-point trades up to 15-point trades, which is small, especially on a 6,000 index. Patricia, I would consider doing swing trade recs, recommendations, and publishing them. So I will definitely take that as something that might be interesting because maybe it would give you more time. I typically, in my own trading, we get flat on Fridays, especially in this environment. I'm not very keen on weekend risk because something can happen in the world and you can have a very heavy duty gap or major gap. But certainly Monday to Friday until Friday at the bell, you could do swing trades that last a few days. So thank you for the question, and I'll get back and we'll consider doing that.
Peter, is there anything that when it comes to gold, for example, or silver, because there's also a huge interest at gold and metal in those markets, are there any, when it comes to silver, for example, is there any forecast that you have when it comes to the price that you expect silver perhaps to achieve in the next time window?
No, I
Let's
don't.
say,
I don't actually cover it, but what I would do would be look at historic ratios between gold and silver because that's meaningful. And in general, it does seem that the Fed moves are going to help drive the metals. And I know that there's a silver craze on right now. Everyone's
yes.
talking to me about silver. But I am a specialist in the S&P 500, so I can't really answer that with any kind of authority or deep experience. But I would look at ratios because I would say whatever the historic high ratio was between silver and gold, given that gold just hit a new high and given all that's happening with other risk assets, I would suppose that ratio could easily be achieved if it hasn't already.
Okay.
Yeah.
And all right. Peter, is there any specific scenario that you can go over, perhaps maybe with illustrating something on a chart where you can demonstrate your analysis of the S&P 500 and perhaps present us with how you go about doing things on a daily basis?
Sure. So here, I'll tell you what happened today, which I didn't publish, which is a remiss. Here we go. So this is the S&P 500 cash. For those who don't know it, there's millions of S&Ps. There's the ETF. You can buy the 500 stocks. You can do a mutual fund, or you can do a future. But the thing is, everything is tied to cash. Cash is the anchor. So cash is the most important thing. So these dashed lines are the days. So this is today. Today is an unusual day because it's the Fed day. People probably already took their positions, and traders are not waiting for the quarter point announcement, but waiting for the commentary afterward. They're waiting for the direction. They want to see what Fed Chair Powell will say. Now, what I'm going to show you now is one of the complications of trading. So these are 5-minute bars, which is a very nice time frame. It screens out noise and also leaves some meaningful information left. These are 3 moving averages. They are the 5, 11, and 20. So a fast, a medium, and a slow. And when you're looking at a trend, you're looking at the moving averages, where they're crossed, the slopes, and their relationship to price. Now, this morning, this was cash. It was pointing down, as you can see. This is slow, medium, and fast, medium, and slow going down. Futures was opposite. And this is what I want to show you and why it can be challenging. So at the day session open, which is this, I'm going to get rid of the horizontal lines. Those were the markers for some trade. This is the day session open, this vertical line. These are futures. Now, futures trade 24 hours a day. Cash has a big break. Cash session is only 6.5 hours. So futures had this as going up. And if you'll see, we did bounce up. There's some resistance here. So mechanically, we have a problem. We have cash pointing down and futures pointing up, right? This is a problem. So this is where you do need to have a system in place. Which one overrides? And in my case, I always say cash rules the day. So cash. So in fact, when this was at 66.72, we did go short, covered here. To Patricia's question, that's a fairly quick trade. It didn't take that long. But if you look here, this is futures. And by the time these crosses occur, the price is down here. So if you sell it here, now you need to wait for another leg down. But cash was much more interesting. Cash was a bit of a leader here. If you look here, we crossed at the end of yesterday and continued at the day session open. So here you could trade these bounces, slow, medium, fast. I prefer a trend and to trade the slow bounce. You have risk of not getting your trade, but if you do get it, you get it at a better risk reward area. I hope people followed me on that. It was a bit of a journey.
Yeah, Peter, please, if you feel like you can expand on this stuff, then go ahead, because in general, everybody's always interested in various scenarios and how experts such as yourself go about their daily routine and how they identify opportunities in the market.
Okay, certainly. So here, this is a daily chart of the S&P 500. Everyone probably knows this chart and sees it. But why is trend following interesting? This is the same. I use simple moving averages. You can use exponential. You can use what you want. They're inherently lagging. What's good about them? They are totally honest, mechanical, unbiased. And the fact is, this price, according to the law of one price and efficient market hypothesis, is the real price. That's not people talking, that's people acting. So here, this April is the tariff scare. If you had a long portfolio, these are daily bars, these are these 3 time frames I prefer. It's really the 5 and 20, but I add the 11 just to see if it's in the middle. When we started to sell off from this 6150 and this area broke, you see these lines here? This was a sign, and it broke pretty good. We're talking about after the cross, 6,000 down to 5,550. That's a decent break. Then we had a little bit of an attempt to recover here, and here we go. Old support becomes new resistance, the old flip-flop, and then we went down again. This capitulation stuff is tough to trade. But on the way back up, if you're a trend follower, this kept you in the market for most of it. And if you take the red and the green, which are the real ones, so the actual red is the 5 and the green is the 20. So those are the primaries, 5s and 20s. I also look at 10s and 40s. It's nice to have two moving averages. Look at when the red crosses the green. Only briefly here, 6,300. Cross occurs here. I'm of the belief to wait a few bars. You have a bounce either on red or on blue. You only get the bounce on the fast here, but we're talking about a 800 point move that kept you in the market if you were a long-term trend follower. Or to Patricia's point, if you were a swing trader and you held on, you're in quite good shape. Now, here was a test. We continue higher. Now this is a difficult moment. We're at all-time highs and there's disappointment, possible disappointment risk. But again, it doesn't matter because I'm following trends, and what the trend tells me to do, I'll do. So this is called the high time frame, HTF. I will use that as the main trend indicator. I have this on a 10-day uptrend, which after day 9 is a little mature in my analysis. The 5-minute is one of my favorites because it takes out a lot of noise. When you start to get to things like 30 seconds, maybe more mean reversion and small trades, same thing with minutes. But 5-minute is a very nice time frame, and I'm not the only one. Renaissance Technologies, a lot of biggest hedge funds really prefer 5 minutes. It's just one of the time frames they look at.
So basically, Peter, you're saying do not go against the trend.
Yeah, the trend is your friend until it bends. Yeah, don't go against the trend. Look, there's a lot of ways to trade. Trend following is the way I chose after a lot of years of looking at the market. As an investor, long-term investing, which is not what I'm doing here, I'm doing short-term trading. If you have fundamentals that are strong of your company, low debt, high buybacks, tight float, a lot of institutional ownership, 70, 80%, what have you, and your technicals are positive, that's your investment, okay? Whatever you do with fundamentals and look at investing, if technicals are not solid or there's not an uptrend, you're value investing and you don't know when it's actually going to happen. And that's okay to do, but you got to realize you're the only one that thinks that is valuable at this moment. Maybe in next month, maybe in the next year, maybe in 5 years, other people will agree with you. But if you're buying something cheap, there's often a reason it's cheap. So my view is always go for the intersection of strong fundamentals and technicals in action now, because that's efficient use of capital. You're where the money is moving now. So one last thing, you asked about the AI stuff. All of these companies are financially in much better shape than any dot-com boom company from those days. Some of those days had valuations of numbers of hits of the website.
On
Some
top
of
of
them
that,
had.
you could say that the technologies are now far more mature, whereas back then things were just, it was a burgeoning industry. There's a fundamental difference in now versus then. Of course, there's that old adage that this time it's different, right? But perhaps at this time it could be different.
Yes, unless AI suddenly goes away, which it's not going to, pets.com can go to zero. I don't see these AI names going to zero. However, I did see an article recently that, again to NVIDIA, from their last earnings call, 2 clients represented 30 or 40% of their whole revenues, client A and B. You can Google this and look it up for yourself. Their names aren't disclosed, so they're possibly, I don't know, Microsoft or Facebook using a proxy buyer. They're wholesale buyers. But the fact that there are huge orders coming from concentrated parties or Palantir and their government contracts, I would say that's my biggest concern. I'm going to answer your question better. That is my biggest concern about this AI bubble, is that a lot of these names that are running up on AI, it's not because 8 billion people are using it all the time and paying them money for it. It's because a handful of big players are providing very big orders. And if something changes there, that could be a point of disappointment. I think that's a better answer.
Sorry, I had my mic off there, Peter. Just very quickly, Robin here is asking, and going back to your chart, are those, give me a second here, let me spotlight the question, are those SMA lines or another type of MA?
No, those are simple moving averages. I've always used those. I know a lot of people like exponential moving averages, but what I do is I just shorten to use 5s and 20s or whatnot, and I use a handful of them. I'll always use at least 2, and 2 is usually enough, but SMAs is my go-to for 30 years.
Just because we're here at we still got about 20 minutes left, I would just like to remind all of you that Peter Levant's analyses are part of the Diamond package on Gold and Meadow. So please go ahead, check them out. Okay, Peter, just because you mentioned that you are you do intraday trading and you don't focus as much on the on bigger time windows. There are fundamental differences when it comes to what traders prioritize and what investors prioritize, what they worry about. And I just wanted to maybe briefly touch upon the psychology factor in all this, and perhaps the type of what methods or what techniques you use when it comes to stress management or dealing with the pressures of intraday trading.
Yeah, good question. Yes,
Because
trading,
that is something that is often ignored, but it's a huge deal, right?
it's more than huge. It's a way to be able to keep doing it and to survive this business of ups and downs. So investing and trading are completely different, actually. You can say you just speed it up to trade, but that has so many ramifications. For investing, obviously it's longer term, lower leverage. You have a point where they call it the can you sleep at night portfolio, right? If you can't sleep, that's probably not the right portfolio, or you're doing something wrong. When it comes to trading, there are 2 active trading methods, and Patricia, the member, pointed that out. There's intraday trading and there's swing trading. The difference is you either carry it just in the day, you close it out and you're flat, so you go home just with money. And swing trading, which you can hold for several days. I think a classic definition is up to a month. But the biggest difference, and to answer your question about stress, is when you're trading, you want to be as mechanical as possible. I was never in the military. My grandfather was, and of course, every person has family members who were. When you go into battle, you have a lot of plans. You've already trained and prepared, and when you see something, you should have seen something similar to it before. And that's the mechanical aspect. So when you're going into the markets and there's ups and downs and it breaks to new levels and there's new thing happening and there's different news flows and all this, you need a plan. And that's why I fell in love with charting, because it's pure and that's what's happening. So I have a plan before you do everything. You have a plan before you even think to turn on your computer. You've done some back testing. You're as mechanical as possible. So to manage the stress, you have to know all those ahead of time. It can't be, oh, our daily loss limit is 3%. I really like this trade. We'll stick it out for 5% loss. Oh, I don't hold overnight, but now I will because I think it will come back. And the next day you opened up and you were long, you bought it, and it gapped down 3%. And now all of a sudden you're getting close to down 10% on one trade when your original risk management was, say, 1 to 2%. So discipline and being as mechanical as possible. So it's not easy. You can automate. Automating is okay. You really need to have the right software, the right connectivity, and you still need to watch it. Someone has to be observing what's happening. So to make a long story short, be as mechanical as you possibly can. Be a little flexible insofar as you can see new things, but there's no harm in disengaging from the market the minute it's something you're not sure about, or the minute it's something you haven't seen before. And furthermore, I know some pretty successful traders that have 3 trades in their arsenal. That's all they do, these 3 trades. They wait for the setups and they do them. There's nothing wrong with that. You don't have to be able to trade everything, every environment, every time frame, every instrument. So just get really good at something and try to repeat it and try to have enough frequency where that adds up.
So that's interesting, Peter, that you mentioned the three things that some traders are just using it, that they're good at, because this came up in one of our last webinars, and that there was the emphasis on specializing in something and not trying to do everything and not trying to specialize in all things, and just to focus on a couple of things and do them well. And would you say that's a far better approach? It seems obvious.
Absolutely.
It seems obvious, but a lot of people
Absolutely.
don't do that. And mhm.
No, I think everything is like that. Imagine the builder who comes to your house and says, "Oh, I'm an expert in plumbing, electricity, roofing, floors. I can do your foundation. I can do your brickwork." He can't be an expert in everything. It's not possible. And trading is very fast, very complex, very challenging, very difficult. And the fact is, everyone I know who is a trader, who's been doing it a long time, usually is a specialist. I really can't even think of someone who's been doing it multi-decades who just jumps to the next hot thing. I'm not sure that's even really sustainable. What I would say is become a specialist or an expert in one thing. Maybe it's trends and you can overlay those trends on other markets. Maybe it's breakout trades, gap trades. Maybe it's a sector. Maybe you're very good at precious metals and you're able to arbitrage between different gold names and see who has the best, most efficient running business or what have you. But become an expert or a specialist in something and get really good at it. That's what I can recommend.
Speaking of gold, of precious metals, we have here a question from Greg. Hello, Greg. Thank you very much for it's a comment question. The best way to analyze gold would be to analyze the cash and transfer to the futures, use the simple moving averages.
Okay. Aha. So analyze the cash chart of gold. Oh, yes. Okay. I can answer this in a general futures way. First thing, yes, I use simple moving averages, and a lot of people do. Trading is really a social science. It's not a physical science. So if most people are using moving averages, if most people use SMAs, if that's the majority, go with it, because you want to be with the herd, but hopefully a little bit in front of them. Just like the S&P cash to futures, gold to futures, I don't know what the metric is now, but it trades at a premium or a discount. And over short time horizons, that's fairly consistent. When the futures contract expires, cash or the underlying and the futures contract converge. That's all, just the way futures work. But yes, you could definitely do that. If you're able to chart basis, I believe, between cash and futures, you can see the relationship. Should be fairly consistent. Sometimes, like in oil, there can be a speculative bubble and there's, I don't know, $20 in risk premium on top of oil during some geopolitical event where it jumps to 120 or something. But I'm sure you can do that with gold. The good thing about gold, it's such a big covered market, it should be very efficient. So futures are a great way to do that at a short time horizon. I don't know about longer ones if it deviates.
Okay, thank you very much, Peter. And again, if this answered your question, Greg, please let us know if you have any follow-up questions to that. Let's go over to Tim Rudy here. Hello, Tim, and thank you very much for your question. The difference between trading/investing. An investor may have 90% of their capital in the S&P. So when you talk about having a limit for each trade, risk capital, and loss management for each day, how many trades can the trader line up at the same time? Probably not many. So they may have only 6 to 12% of their capital working for them. I guess the rate of return is supposed to be much higher, and that's as a question.
Tim, that's a really good question. I'm going to unpack it. And basically, we talk about this all the time. This has to do with the sequencing of trades, so the order that you trade. And essentially, if you're day trading, intraday trading, you're reusing the same money over and over again. So let's just take an example of a 2% risk, which is a pretty solid, aggressive risk, but within the bounds. If you risk 2% per day on one trade and your rule is one trade a day, you can do the math. You know what that is. Now, if you risk more than that in sequence, obviously you can decide if my first trade makes 2%, say it's 1-to-1, say you're not doing ratio trades of risking 1 to make 5, because in fact, there's a trade-off between probability and ratio. Every trade that you risk 1 to make 10 has a fairly low probability. And you can identify trades that are 1 to 1.5, 1 to 2, 1 to 1 that have higher probability. So say your first trade is a loss, you can call it quits. Say the first trade is a gain, you can go on to the next one. Now, to your point, you cannot have a lot of trades working at the same time in the same market unless you've done the work and you've shown that those strategies have very low correlation or potentially negative, but I prefer zero correlation. Because what if you've diversified yourself, you put on 6 trades, they're all 2% risk, but in fact, all those strategies have a high correlation. You get stopped out of all 6. 6 times 2 is 12. You just lost 12%. Wow. So you just actually increased your risk by 6. You didn't really accomplish anything. So that's an excellent question. And if you're trading the S&P, for example, if you're doing multiple strategies in different accounts or with MES or ES, the big one or the small one, or with options, really understand your strategy that you're not just increasing risk. Make sure you're accomplishing something by trading different strategies. Trend following satisfies this because if it's a downtrend and we're betting on the short side, betting more on the short side is just increasing the size of the trade effectively, right? To answer your question, we do it sequentially. We don't have more than one trade on at a time. And we typically do one trade a day, sometimes 2. And our max is at 2%, but during high volatility times, it can be 3. But that's a very good question. Thanks for asking it.
Okay, thank you very much, Tim, and let us know if you have any follow-up questions to that. Patricia is asking, I read that you have had extensive experience with the big institutions. What was it like? What is the most valuable thing that you learned there that you could share with us? Perhaps, Peter, also comparing the big institutions to us small people.
Yeah.
Any lessons for us?
Yeah, lessons. Definitely be a part of a community, Golden Meadow or some other support system, because being alone and being in an office or your apartment or your home and engaging with the market is hard. It's good to have feedback mechanisms. The market gives you feedback from charts and from prices. Of course, we get that, but also just a little bit of camaraderie. What did I learn working in big places? That they're brutal, and if you make a mistake, they'll find someone else to fill your seat. So I never made a trade mistake in all my years. I never had one trade error because I triple checked. What else did I learn? That, yeah, careful for order flow. So again, this kind of goes back to being the only one who's right and being the contrarian. I think contrarian investing is very interesting, especially if like you're doing real estate and you know that neighborhood's going to go up or there's a factory coming, you buy homes in front of it. That's very interesting. But in the trading world, big people don't want to be wrong, and they would rather be wrong in a group, yeah, or risk versus being wrong alone. So if you're working at a big place, a big hedge fund, a big investment bank, if you go out on a limb and think something different, it's a fairly big career risk move. You're either going to be a big winner or a big loser. If you're a big loser, you could lose your job. So unfortunately, what I also learned was there's not a lot of creativity working at big firms because you got to follow the company line. And I would say there's an advantage to being an individual person who can use your brain, who can follow a trend, even if, for example, the firm says you should be doing something, but the trend says something else. So what did I learn? I learned to work 15 hours a day. I also learned that it's better to be working for yourself. But when you're on your own, you have to have some serious mechanisms in place and some support. I hope that answered your question.
Yeah, thank you very much, Peter, because that is a very important thing that's often also not talked about, is the importance of having a community there to bounce ideas off of, and like you said, to have some sort of feedback when it comes to what we're doing. Patricia here has another question regarding the correlated markets. But if you go long in one and short in the other, then you hedge, right? So I guess more trades would be okay.
Okay, that's a very tricky question. I'll try to answer it with an example.
Peter, and also feel free to share your screen if there's anything that you want to illustrate
Sure.
that are awesome
Because I
charts would be concerned.
wasn't, yeah, thanks. I wasn't ready for it, so I'll try to articulate it in words without pictures. I did a lot of work on correlated markets after London for a few years, and the problem with correlations is that they're temporal. Correlations don't always hold. For example, at the moment, Bitcoin is acting as a beta and it's trading the same direction as stocks, but that can change. So, with regards to going long one and short the other, the simplest example was in the old days, long short equity hedge fund managers. You buy long a good company, you sell short a bad company, and you hope that obviously your good company goes up in price and your bad one, that you found some monkey business in the financials, or they're writing revenue, but their cash flow is weakening, so they're not collecting on their orders, so you short that stock. So they're unrelated, and that's very good. And that you're really creating alpha then. That's a very interesting strategy. The problem with long short trades like in futures, for example, soybeans and soybean oil, and these spreads that have to do with industries, is that they change, the relationship change, and you can actually lose on both. So going long one and short the other doesn't mean you're for sure hedged, because there are times when you're wrong and your long is going down, your short is going up. And now what you thought a spread relationship was going to hold and it didn't. One of the best trades I ever did a long time ago was the Hewlett-Packard merger with Compaq. So they announced this is called merger arbitrage. So one company is going to buy another. There's a takeover price, but the deal isn't done for 3 months from now or 2 months from now. So during that time, both shares trade, and when the deal looks like it's good, they converge, and when the deal looks weak, they go apart. Now, if you have good information, you believe that merger is going to happen, ultimately they're going to arrive at this. So when they're this, you can sell this, buy this, or do just one leg of it. So that long short is interesting because it has a time component and you suspect it's going to happen. But long short trading isn't for sure okay, because sometimes both sides can fall apart. Also, we did airline stock spreads and other types where one business is running well, the other isn't. But going long and short, it's useful, yes. And if you can balance it, it's okay. But it's not a way to totally avoid risk. You have to know that.
These are very valuable lessons, Peter, and I hope that we'll have more opportunities to have future webinars in the very near future where we can answer more of these questions. Peter, is there anything that you would like to leave us with for the short term, or for right now, for the perhaps rest of the month? It's the 17th right now.
Okay. I'll leave you with one thing, and that is that always try to protect your capital. And for example, when the dot-com boom went straight up and went parabolic, NASDAQ touched 5,000 back then, which was incredible. I was fully invested. And when the NASDAQ dipped below 4,000, I completely pulled out of the market. Not because I'm smart, just because I was a technician. And the fact is, those numbers started to be nosebleed numbers. They were just too high. So there's nothing wrong with if the reasons you got into it reverse, pulling out. That's fine. Now, this market is a very different kind of a market. So I'm not advising that to anyone at this moment. And if you see the big chart, COVID, the tariffs, those were all buy opportunities, right? So if you stood and didn't sell, you ultimately did okay. So that's tricky. But I would say definitely explore trend following. It'll keep you on the right side of the market. That's the moving averages I showed you was the simple version. There's a lot more to it. There's money management. There's ratios versus probabilities. There's a whole lot of things to explore and get into. But in general, trend following, systematic trend following is the trading strategy that we have the longest set of data on and that the most successful traders in the world have been doing for many decades. So I didn't invent this. I changed some of the metrics to my own liking and to what I prefer. But definitely, whatever you're doing, look at the trends, look at the relationships between what you have, because sometimes you think you have a lot of different stuff and you don't. And if you look at times of stress, correlations go to one, and often only one thing is going up, like gold or treasuries, and everything else is crashing. Stress test your stuff a little bit, and I hope that's useful. And if you have more questions, you can send them later.
Thank you very much, Peter. Again, to everybody, for those of you who are here and for those of you who will be watching this after the webinar is over, Peter's Trend Tracker newsletter is on Golden Meadow. It is part of the Diamond package, so please have a look. And as well, Peter, I would like to ask you, in terms of your services, how does that work? Because that would be beneficial also for those who are interested in such a thing. Perhaps you could just provide us with a few words about that.
Sure. I've been with index research for about 5 years now, and what we do is we write trading algorithms, and we, in fact, for a fee, lease them out to traders. We are very active in developing trading strategies. You can look at our advisory board. We've got some very smart people, some of the smartest people pretty much around doing this. And basically, the way it works is the clients have their own individual account in their own name. And then we go ahead and provide a trading strategy that's executed by a broker. And then we get a fee for that, a monthly fee. So we've shifted our business model to match up with the times, which is really separating things. And actually, this is the most interesting part of the market, I think, is the trading, the strategies. We've got so much going on in the market. All of the things we talked about, concentration, actually have led to brand new strategies, which are very interesting and have pretty good probabilities. So that's what we do. We develop strategies and then we give them to clients for a fee.
Okay, Peter, thank you very much. And so again, for those of you who are interested in what Peter is providing, then please reach out to our product support at Golden Meadow. Peter, thank you very much for being here with us today. Let's book another webinar sometime soon.
Thank you, Dominic.
Thank you. All right. Take care, everybody. Bye-bye.